Hey everyone, I'm Tony with Clarkson's Editorial, and this is our weekly real estate update for August 4th. In this weekly series, we update you on the latest trends that are occurring in our real estate market here in San Ramon. Using our more than 50 combined years of experience helping clients buy and sell homes, we explain what those trends mean for you as a homeowner or as someone looking for a house that you will love to call home. The current inventory is 105 homes, down from 115 last week. The average asking price of those homes was $2,019,000, which is up from last week's average of $2,013,000. 16 homes asking an average of $1,828,000 went pending this week. That is more pending homes than last week's number of 11, with a higher average asking price from last week's $1,768,000. A total of 10 homes sold this week with an average sales price of $2,319,000. That average price was up from last week's average price of $2,087,000, and that total number of homes sold was higher than last week's 8. Now that we know how the market performed this last week, let's look at 6 of the leading indicators that we track. The first 4 track broader trends of the past few months, and the last 2 give us a guidance of where the market might be heading. The first indicator we watch is our active home inventory levels. Our inventory declined almost 10% last week, and is now at the lowest level since the first week of July. With inventory coming down slightly, another key point to note is that we also have seen a significant decrease in coming soon listings. There has been an average of 15 homes listed as coming soon for the past few months. However, in the past 2 weeks, that number has remained in the single digits. Inventory is still higher than a normal market, but if this trend continues, it could return us to a neutral market that we haven't seen in years. Last week, we gave this indicator a score of 17, and this week, we are raising it to 23. The next indicator that we track flows directly from inventory levels, and that is the market turnover rate. In a neutral market that doesn't favor a buyer or seller, we see this turnover number at around 1. During the extremely hot market that we experienced in the previous 2 years, that number stayed well above 2 and peaked at over 10 at some points during the hottest part of the market. However, since the end of May, the turnover has been less than 1. Meaning it would take more than a month for every single home for sale to accept an offer. That number has dropped to as low as 0.25, but is now back up to 0.5. That is still slower than a typical turnover, but the increase is another sign that we're moving towards market equilibrium. Last week we gave this indicator a score of 20. This week our rating is higher at 25. The over-under asking price is the next indicator that we track. This number has been dropping precipitously since the middle of May and only recently shifted from an over-the-list price number to an under-the-list price number in the past week and a half. But this really means that sellers started receiving and accepting offers below asking price over a month ago, because that number lags due to the typical 30-day escrow. This is the first time in over 2 years that the 30-day rolling average of over-under sales price has been under the list price. This indicates that sellers have shifted pricing strategy to a more transparent price, asking price that is still slightly overinflating the value because of the last 2 years of sales. This also points to the fact that buyers are no longer competing over the same homes, so there are less bidding wars occurring. Last week we gave this indicator a score of 50, and today we are lowering it a bit more to just 47. The last trend we watch closely is the average sale price of homes. While the average sales price has declined since the end of May this year, there are some important things to keep in mind while considering this number. The first thing is that although the average sales price has dropped around $400,000 since its peak in May, that has been mostly due to the continued higher sales activity in the lower priced homes. What this means is that while the overall sales price has dropped by about 17%, most homes have not actually lost that much value since the peak of the market. The other important thing to note is that our current year-to-date average sales price, we are still about 10% ahead of last year's average sales price. Last week we gave this indicator a score of 60, and this week we are raising it to 65. The first of the predictive indicators we track is the valuation of the Silicon Valley high-tech sector. This number is important for San Ramon specifically because of the number of buyers we have seen come out of the Silicon Valley in recent years. A large proportion of our home buyers in our city use their investment portfolio from the tech industry to fund their down payment on mortgages. We watch the Invesco Triple Q to see how tech portfolios are performing, and there is a reasonable correlation between the strength of the tech market and the competition for homes in San Ramon. Since January, the QQQ fund dropped from 401 to a low in the 270s in July, but it has since rebounded by about 19% and now sits in the 320s. Last week we gave this indicator a score of 40, and this week we are upgrading it to 45, a small increase. The last indicator that we follow are mortgage interest rates. And other than the drop in the stock market, this has had the largest impact on buyer activity in San Ramon this year. Last year and through the past 2 years, the interest rates were sitting at historical lows, giving buyers much more financial flexibility, which in turn fueled extreme competition over the homes for sale. The interest rates have climbed steadily since the beginning of the year, almost reaching 6%. And with the Federal Reserve continuing to raise the borrowing rates, we feared that mortgage rates would continue in that trend. Fortunately, mortgage rates have actually dropped to below 5% for the first time since April. Last week, we gave this indicator a score of 37, and this week we are going to raise it to 40. Overall, we are experiencing a steady improvement in the market, and if this trend continues for another month, we may see the return of a semi-normal market. For sellers, this means that there are fewer homes on the market competing for a buyer's attention over yours, and buyers have a little more flexibility in the amount they can spend on their home purchases. But the responsibility to make your house extra attractive, whether by finishing up that last remodel project or pricing your home to beat out the competition, is still on you because buyers still have a good number of homes to choose from. For buyers, we think this is as good a time as any to get into the market. There's always a chance that home prices will continue to come down, but since they have already dropped 10% from the peak, it could be the best time to buy as we see the trend line starting to shift back to a more neutral market where you will no longer have your pick of the litter. It is likely that we will see our market turnover recover to a neutral 1 number by the end of the year. Last week we gave the overall market a score of 35, but this week we are raising it to 39, a clear sign that we are heading in the right direction of a more normal market. I hope this weekly summary and commentary helped you understand our market better and how it is affecting you. Let me know in the comments down below or contact us directly if you have specific questions about how you can navigate this market to sell or buy a home. And if you find this information helpful, share it with a friend. Hit the like button and subscribe so that you'll always be up to date on the latest real estate news here in San Ramon. We hope you had a good weekend, and we'll see you next week with a new update.